Hello everyone, this is Pattu from freefincal.com. Let's look at how to invest a lump sum in an equity mutual fund. Many people get confused about this and they get worried that the market valuation is so high and they'll lose a lot of money if they put it all in one shot. There's really no such, there's no need to have such fears. Let's look at four steps to consider before investing a lump sum in an equity mutual fund. The first is to have a clear plan. When do you need the money? Do you need it within 5 years, within 10 years, beyond that, and so on? So have a clear goal in mind about when you need the money and what is the need. So if you need the money within 5 years, stay away from all forms of equity. If you need the money within 10 years, do not have more than 20 to 30% of equity in the overall portfolio. If you want to manage it with minimal effort. If you want to actively manage it, you can have more equity, but that will require a lot more effort. Beyond 10 years, you can consider 50 to 60% of equity. But again, that will also require some amount of management to reduce risk. But please be ready to face negative returns no matter how long the investment duration. So having a clear plan is essential, and you're only going to invest money that you're not going to take out within the next year or next couple of years and so on. So the second is to define a lump sum. Now, if I have a portfolio of let's say 1 lakh, then if I suddenly get 50,000 with me, that's a lump sum to me. But if I have a portfolio of 1 crore, then I would say even 5 lakhs is not really a lump sum. So you should define what is a lump sum. That is, what amount is actually a big amount for you. So and please recognize that when you initially start investing, you lose like hundreds or thousands of rupees every day, or gain thousands of rupees. Then slowly you will as the portfolio grows, you will even end up gaining or losing a few lakhs every day. So at that point of time, 1 or 2 lakhs will look small to you, and it's not a lump sum. So define what a lump sum is. Let's say 50,000 is a lump sum for this video. And please do not use systematic transfer plans. STPs are designed for distributors and mutual fund houses to lock in your money like a like a gold jewel scheme. Don't do that. Every time you take out money from the debt mutual fund to the equity mutual fund, you will have to pay tax. It is an unnecessary thing to do. There's really no benefit at all by using a STP. Today you can open an account directly with the mutual fund house, or you can use MF utility, and you can manually invest from your bank account to the fund that you want in under a minute. With some experience, you can do it in 30 seconds as well. So it's really no big deal. Then there's no need for STPs. Don't do that. So if you have 50,000 and define that as a lump sum, divide that into small chunks. Let's say 5,000 or 10,000. 10,000 is okay. I think it's fairly reasonable. You can invest from your account 10,000 once a week, or if that's too often for you, once in 2 weeks, or maybe even once a month, and finish it off within 4 to 6 months. Just be done with it. This amount you're not going to touch for at least the next 5 years. That should be your goal, and therefore get rid of it within a few months at best, and that's it. It's as simple as that. There's no need to worry about it. What you should be worrying about is the asset allocation for your goal. How much should I put in equity overall, and how much in fixed income, and is that the correct strategy for your goal? And not spend time worrying about how to invest a lump sum, when to invest it, should I do it now, should I do an STP, should I do it over for 1 year, and so on. So don't do all that. It's quite a simple situation. See you again in another video. Bye bye.